analyst for Enpro International Inc., a firm that does a lot of work in basically understanding what drives the fuel markets. And Roger, I'm going to start with you first because I want to make sure that we place the issue of fuel pricing in context before we move on to discuss what we have to do in order to account for the volatility in fuel pricing. So the first question I want to ask you, Roger, is that every time fuel pricing starts to rise, we get all sorts of theories about why prices are acting the way they are. What are the reasons given by the oil industry for the radical increases in fuel costs?
That's a pretty fair question. First of all, I think that there should be another award, another Nobel Prize. It should be for solving riddles, and the riddle would be how the heck the oil companies actually price their fuel. There are a number of reasons given for fuel price gyrations, mostly in the upward movement. The first one is low inventories of diesel. There are two reporting mechanisms used. There's the API, the American Petroleum Institute, and there's the EIA, which is a subset of the U.S. Department of Energy. The API is industry funded, and they're looked at with a jaundiced eye as far as their stats are concerned, because it's in their better interest to show a big panic in the inventory levels. The EIA is government mandated reporting, and that comes out, the short form comes out Wednesdays at 10:30 every week. Without that, world pricing would be a complete schmozzle, because it is so detailed and so well respected by speculators and traders throughout the world. It is absolutely invaluable. Now, when you have low inventories, that's basically because it could be a factor of weather. Okay, it depends on the time of year. First of all, there are two seasons in the distillate market. There's the October to March, which is the high demand area. That's when heating oil comes into play, and then you have from April to end of September, which is another season, which is really the gasoline season. So your high demand season is October to March. Now, the reasons for high demand is basically because you can have extremes of temperature, which affects heating oil. Heating oil, 74% of the heating oil in the U.S. comes from the U.S. Northeast, which is referred to as PAD 1. So when you have a severe winter, you've got a high draw on heating oil. That draws down distillates as well. It used to be that distillates were broken up into heating oil, diesel, and jet fuel. But with the sulfur content level for heating oil now down to 15 parts per million, just like ULSD, you've got ULSD competing against heating oil because of the same thing. So when you have a severe cold snap in the winter, your prices go right through the roof. The other reason they give is refinery problems. There are all of 139 refineries in the United States and 13 and counting down in Canada. Canada, we lost the Shell refinery in Montreal, 130,000 barrels. We've lost the Esso Dartmouth refinery that was built in 1919, by the way. That was 84,000 barrels, and we're about to lose, I believe, the Come By Chance refinery in Newfoundland, because that's a deepwater port with no access to the lower price crude. So anytime there's a refinery problem, there's an immediate hit in your pricing. I'll give you a quick example. Last Wednesday, the EIA report came out, and I looked at it and I said, okay, refinery runs are down to 87%. There was a huge jump in crude. It was 4.1 million. So I said, and the demand, as usual, is flat. I'll get to that a bit later. And I said, okay, so prices at the pump. I do the 680 News gas price update every day. And I said, it looks to me like prices should go down. But lo and behold, 3 o'clock that afternoon, prices went up. And the reason why is that the largest refinery in our country is the Irving one in St. John. It had a problem with the cat cracker. That cut back 74,000 barrels a day of gasoline. That refinery is key to supplying the New York Harbor gasoline market, and that's where the speculators set the price. It's based on speculation. An hour later, another refinery in the Philadelphia area had exactly the same problem, so all the gasoline prices jumped by 1.2 cents a liter, whereas I said it should have gone down. The other thing you can have is pipeline problems. problem we have right now with pipelines is that they're, pardon the language, they're pretty well constipated with crude. There's nowhere for it to go. That's because of the, I'm told not to get political, some decision-making problems for the leader of the United States of America, the dithering basically, is the XL pipeline that should be approved. That can be solved by the use of rail, but we can get into that a little bit later. Questions of the economy. We've been in a recession, I guess, for 5 years now, and the U.S. keeps printing money. That really affects the U.S. dollar. When the U.S. dollar is strong, the cost of crude goes down. And when the U.S. dollar is weak, then everybody goes into the commodity markets, and the price of crude goes up. The low loonie. People don't quite understand that the crude is bought in U.S. dollars. So when the loonie is weak, it costs more Canadian dollars to buy that same amount of crude. So when the public sees in the newspapers, crude went down $5 a barrel, they all say, oh, okay, so that means the price at the pump is going to go down too. Not necessarily, because of the weaker loonie. Big thing right now is U.S. politics with the debt ceiling. The economy is not knowing where it's going whatsoever. All sorts of different things that the Obama administration is having problems with. And when you get into, if it's an election year, we can't make a decision on that pipeline because it's going to be an election year. Then they have midterms, so every 2 years they seem to have an election, which messes up the whole decision-making process. Big thing right now is geopolitical friction. That's basically the Libyan situation, the Syrian situation, the Egyptian situation of situations. It all tells the speculators there could be a hiccup in the supply of crude oil. Libya was February 2011. It does 2 million barrels a day of crude, virtually nothing. In the larger scale of things, we did go through 89 million barrels a day anyway. So the U.S. government said, well, they have a strategic petroleum reserve, which is about 700 million barrels. They couldn't even get it to New York Harbor because of what they call the Jones Act, which restricts any movement within the country, within the United States, to be carried by U.S. carriers that are owned, operated, and flagged in the United States, so they couldn't even do that. Roll it all together and you have what we call speculation, which is speculation. Speculators are looked at as the lowest form of life. But when you look at it, that's what the stock market is. It is speculation. You're guessing that XYZ stock is going to go up. So I'm speculating it's going to go up. So I badmouth them a fair amount when they're just panicking over rumor. But if they base it on fact, I'm fine with that.
So, I mean, listening to what some of the folks say is that the costs really are attributed to an imbalance between supply and demand. But from what I'm hearing you say, is there's a lot more involved to it than simply that.
Yes, it's very, very complicated. It's like a Chinese alphabet vegetable soup. It's made of so many different chemicals. It's nuts. In this slide here, I'm a bit concerned about something that's happening. The flood of crude from the Bakken field and what we call WCS, Western Canadian Select, the oil sands crude, is giving refiners in the Gulf a very low-cost feedstock. West Texas Intermediate today is trading at 94. Western Canadian Select is discounting that by $40 a barrel. So these are fine. All this stuff is going down to the U.S., all right? It's being refined into gasoline and diesel and sent to Latin America, mainly Brazil and Mexico. So what I'm seeing is you're getting a drop in distillate inventories when we're coming into the heating season when it should be going up. Yet in this graph here, we see that the export level of diesel and gasoline has gone up by 70% since July and not stopping. Now this is where some politician in the States is going to grab a hold of this and run with it pretty quick, because if I'm Joe Consumer sitting in Kansas or Joe Consumer sitting in Saskatoon and I'm seeing all this low-cost crude, I'm not seeing it at the pump. So basically the Canadian oil sands crude and the Bakken crude is really subsidizing the U.S. refiners. They're the ones making the money.
Okay, so looking ahead now, put your crystal ball on. Looking ahead 6 months to a year, what are going to be the main drivers that are going to be pushing that price?
Well, we got to get the product to the market, and right now on this slide here, the southern leg of the XL is basically being filled now and ready to go. So you got to relieve that plug of crude that you have at Cushing, Oklahoma, which is where the pricing is all set. You got to get it down to the States. There's been a reversal of a pipeline called the Seaway, which is the Enbridge line. That's going to bring 400,000 barrels a day into the Gulf as well. And you can get the Bakken to the east by rail, which is going absolutely phenomenally high right now, both west and east. The problem that the refiners have east of the Ohio Valley is they cannot refine heavy sour crude, or the Western Canadian Select. They have to refine the type of product that Bakken has, or what we call the Brent crude. So anything east of the Ohio Valley, if you're looking at pricing from Chicago west of the Ohio Valley, east of the Ohio Valley, you have to follow the Brent pricing mechanism that you see in the newspapers, not the WTI, which would be based in Chicago. So until such time as those refineries in Montreal, Quebec City, in St. John and in Philadelphia, until such time as they can accept the heavy sour crude, they're stuck with the higher cost Brent. For them to convert a refinery to take the heavy sour requires cokers and hydrotreaters, and they're $1 billion a pop. So you don't just buy them off the shelf. What's going to happen when the southern leg gets going and the Bakken moves to the east? You're going to have a lower demand for the West Texas Intermediate benchmark crude because nobody's going to want it. So WTI is going to fall rapidly. In sympathy, so will prices. You're going to have a higher demand for Western Canadian Select and a higher demand for Bakken. The next slide, please. The other thing is you have a very huge refinery in the Chicago area coming on stream. It's 430,000 barrels a day, and that is solely devoted to Western Canadian Select, the heavy sour stuff. So my prediction is I'm going to really change that 6 to 9 months out because 12 is too far. I can see diesel supply, West Texas Intermediate will fall by 10%. It'll end up at about $90 a barrel. That'll be reflected in the rack, so you should see a 10% reduction in your fuel costs at the rack, especially in the east. In the west, you're going to have an increase in diesel supply, mainly because of a refineries such as the type you have at Whiting. And I see prices dropping 5 to 8%. And the reason for the difference in the percentages is you're going to have your feedstock for the Midwestern refiners is going to edge up because of the demand coming up as well. But that refinery is going to dampen that increase.
Well, that sounds like very good news. I certainly hope you're right. I think everyone in this room is certainly hoping you're right. Folks, do seek this gentleman out after the session is over. He clearly knows a lot about fuel, and I'm sure you'd be happy to discuss it further with these folks.